back to Nearsight and Farsight. I'm your host, Kevin Taylor. Today we're going to talk about the election and what we think is going to happen to capital markets. This is the first Nearsight and Farsight since the president has been sworn in. We think that that's going to make for a couple of different changes in some, more so in some sectors than in other. We think that the president has sectors that he likes, and we think he's got relationships that he likes to cultivate. And we're going to see some improved regulatory changes in those sectors. And we'll talk a little bit about where we think the benefits exist. I think it's also time to talk a little bit about some changes we've made in the portfolio that discuss the nature of energy prices. There has been a seismic shift in the energy pricing market. The cost of electricity has gone up about 30% in the last 2 decades, and so it's time to start seeing some solutions there. We think that with the new presidency and with that change in the economic conditions of electricity, we're going to see a big uptick in the need for more alternatives and where those alternatives are going to come from, and even some of the changes that are going to happen in the traditional space. And then finally, I think it's important that we talk about the tariffs. That's been kind of the word of vogue as of late, that it's entered everybody's zeitgeist. Everybody has varying opinions on it. We're going to stand on the side of economists, many economists who think that this is a terrible situation to put the American consumer in, that it's not going to be beneficial for our economics. We're not going to see development. We're not going to see jobs. Let's hope that it is just a bargaining chip, and let's hope that we're successful in those bargaining, and let's hope that this come to a swift and easy end to that situation. Again, this is Nearsight and Farsight. Welcome. So it's usually pretty impossible to separate the behaviors, the beliefs of the presidents from how we invest. It's been our longstanding tradition and belief that very few times does the president control what the individual CEOs do, because it's usually pretty hands-off. We do think that with the introduction of Donald Trump as the president, there's going to be a lot of changes in the regulatory and compliance view of the role of government in private enterprise. And we think that that's actually going to be pretty good for markets. One, I think that the taxes that they're introducing, a little ambitious as of yesterday's announcement as to what's going to get cut, but we do think that the tax cuts from 6 years ago are going to be made permanent. We do think that there is going to be this lower tax regime for a long time, which should be good for the S&P, should be good for companies in that space. But then we also think that this president is going to have a few different sectors that will do better than they have done historically. And so we'll talk a little bit about those and how we're making changes in the portfolio, in your portfolio to accommodate. The first of those sectors is tech. It's the largest part of the American economy. It's easily the most important. And while it has thrived under Biden, it thrived under Trump before him, it has been gangbusters for decades. We have actually backed down our holdings in tech down to a market weight. It's about 30% of the S&P 500. We're at about 30% of it now, largely because there's a few players in that space that I do think are going to get the ire of the president, but it's also just because that run has been so far so fast that it's time for the other 10 sectors of the S&P 500 to catch up. While we don't think the president is going to be particularly damaging to tech, it is still the place where all the free cash flow lives, where all the growth and innovation is. We think that tariffs could have a negative impact, especially if there's export controls on things that we do really well, like chips. But there's so much other places to be excited about in AI and in crypto and in data services, and then the applications that people are using, that technology is going to continue to do well. We just think it's really expensive right now, and we don't see a uniquely advantageous situation to go above what the market has it weighted in for now. So we've kind of been backing off a little bit of tech, but we are still very much tech invested, just not extra tech. A couple of the spaces that we are now going to be overweight as a result of the election, and we've already made some of these changes, is to own more financials. We think that the deregulation efforts, potential interest rate adjustments from pressure that he's going to put on the Fed, will expect the banks to be more profitable. Banks, trusts, all of the kind of the laggard late stage economic companies like banks are going to do pretty well. And all of this in the financial space is about 98% those, and the remainder comes into some other institutions, and then there's about 5 to 6% that are insurance companies, which we don't think that they will do as well, but they think financials through deregulation, a lower interest rate environment, should do pretty well. We think that that the lending will become a little bit more predictable, and they won't have hiccups like we had seen in the early part of the Biden administration with some of the smaller banks, because the regulatory issues and the things that drive them into that kind of uncertainty will be a little bit easier to accommodate. We also think that there's going to be a lot of technological innovations that are going to be allowed in the financial space. This includes adoption of the blockchain. This includes adding some more crypto, adding some irregular assets, and allowing those banks to traffic in those spaces where they've been prohibited up until this point. We've seen a lot of different key players, including David Sack, be part of the inner circle of the president. The Treasury Secretary Bessemer is a crypto and a blockchain and a technology friendly individual, and so we think that some of those prohibitions that have held them out of the financial space, particularly the tier 1 institutions, the biggest of the banks and the Treasury, could see some great adoptions of some technology that has been long needed for these groups to operate in a modern financial sphere. The third, and probably the most important sector we think will do really well because of the election and because of the relationships that they've forged with the president, are in the energy space. Fossil fuel production has long been, the Republican mainstream, the Republican group of people. The president saw lots of donations from the energy players in this space. We think that domestic sourced energy, and even, I know that the tariffs have caused some question, even Canadian sourced energy production stand to benefit here in the United States. Lower regulatory environment, fewer export controls are going to bring that back. Now, energy is kind of still a weird space. If they do produce more, the price comes down. And so while we don't think that they are going to produce more raw energy out of the ground, we do think they're going to get a better market for it. They're going to be able to control their own production, to keep those prices high, and to keep their profits. That, coupled with a lower tax environment, fewer regulatory costs, we think that that while energy, I'm talking fossil fuels here, while energy is not going to be consumed at a larger rate, the profitability of that energy is going to do better over the 4 years to come as a change in how they are taxed and how they are regulated. And so those are a couple of things that we have added to the portfolio, what we think are going to be important shifts over the coming years, and those are our justifications. So one of the important things I think we're going to discuss in this quarter's market update is electricity prices and the investment implications that are coming from that. And so I think it's important to talk about the rising cost of electricity in the United States. Cities in the aggregate have crossed over 17 cents per kilowatt hour, which is an all-time high for what people are paying for electricity. This is driven by a couple of different things, many of which are structural and some of which are short-term. Over the past 2 decades, we've seen a pretty steady rise in the cost of electricity, but not outpacing inflation and other related inputs into the economy. That is no longer the case. In the late 2000s, we'd seen kind of a spike into electricity usage, and then it tapering off for almost the full 2 decades between 2000 and 2020. After 2020, obviously the pandemic probably played a large role in that, but even as the pandemic subsided, there is a marked increase in the trajectory and cost of electricity rates in the United States. A couple of key drivers for this increase. The shift towards renewable energies like solar and wind have required substantial infrastructure and investments be made, and that, they are now producing that electricity, but that comes with a higher cost through this transition. The fossil fuel volatility is more of a short-term impact on these electricity rates. So fossil fuels still account for about 80% of total U.S. energy consumption. And there's been a lot of geopolitical disruptions in those markets, particularly when it comes to things like coal exports, which have a supply chain issue, and then natural gas being dislocated. The places where natural gas is produced isn't really where the electricity is consumed, and that natural disjunction in the market is causing even more demand supply disruption, and that's being bridged by higher prices. The inflation and regulatory pressures have also added to it. There were a lot of hostile measures under the last administrations as far as where fossil fuel inputs could be put in, and we think that those will go away, but some of the damage has already been done on the cost of electricity. I think the largest impact on this increase in costs comes from the demand side of the equation. A lot of those other things are supply side. The demand side has seen a whole new ecosystem arise in the last 5 years, some of which even longer. But the rise in the adoption of electric vehicles is putting more demand on the grid, drives up prices. A lot of the tech infrastructure that's being built, so everybody talks about chips with the likes of NVIDIA, AMD, ARM, Broadcom that are being produced, but now we're actually seeing some of those data centers and those computational centers being used, and that's putting a lot of strain on the power consumption, and so again that drives up a lot of the cost. And so we are viewing this as almost a permanent change to the electricity, to the cost cycle for electric consumption. And so for us, we're making a couple subtle shifts in our portfolio because we think that this is possibly a permanent shift in the cost of electricity, but also we see a couple of early adopters in the nuclear space, as well as some off-grid solutions like hydrogen being able to step into this space while those costs are high. Those businesses become a lot more viable. So some of the early phase development of nuclear and hydrogen solutions become really appealing because those are where the investment needs to be made. Now, who's the first mover in that space is getting a little interesting. While historically that has been utility companies building a property that can generate electricity, we're now seeing applications come from the likes of Meta and Amazon where they want to explore the idea of putting in nuclear facilities near their power consumption, near their data warehouses, to kind of shorten that distance, to lower that cost. And because they're so big and scalable on the technology side, viewing something like the billions of dollars that goes into building a nuclear power plant is chump change for them, and they're actually starting to see the economics of it. If this long-term pressure continues, we think that the operators, we think that the miners, we think that the developers who actually build nuclear power plants could see a whole new golden age. We're kind of living down some of the historical concerns with that power source. Things that we had seen here in the United States, even a couple decades ago at the Fukushima reactor in Japan, that type of fear and concern is starting to diminish, and embracing this clean, something we can construct where the power is consumed, so it's clean and efficient. Adoption is something that we think is going to be more important for the years to come. We also think that the new administration is open to all kinds of energy. Obviously, their bread and butter has been paid for by the fossil fuel energies, but some of the things that Donald Trump has said has indicated to us, and I think other players in the market, that any source of domestically produced energy is something that they're willing to get on board with. And while he's criticized the solar and the wind elements, nuclear, I think he's been somebody saying that is more viable. There's a lot more upside, I think, to nuclear than there is to the solar and wind. There's natural limitations. They are a great bridge energy, but the benefits of being able to supply a nuclear reactor right where the power is being consumed and used is something that no other energy producing source, fossil fuels, wind, solar, can really do. We could put a nuclear power plant anywhere, and anywhere where the conditions make sense economically. And so that's a pretty interesting space. So we started adding some of the nuclear renewables, some of the early phase companies that build those types of reactors, as well as some of the miners that produce the necessary raw materials for bringing those reactors online. So we've added some of that to the portfolio, and we think that energy consumption across the board is going to be an important early step that we're seeing starting to develop in power markets. So we can't talk about investing right now. We can't talk about markets right now if we don't talk about tariffs. Since I started writing these details down, since I started noodling on what this market update was going to be talking about, we started with what tariffs are going to look like. We've gone through about 3, maybe 4 different little micro trade wars, which are disrupting markets. And so one of the things that we're going to say is that we are against any of the tariffs. We're against tariffs whether or not they are actually implemented and they collect any tariff on an import, or even if they're just used in trade in headlines to try to get people to the table. All of this talk is actually disrupting markets, and it's going to have a negative consequence. The people who allocate capital, the companies who run these businesses cannot handle 3 years of back and forth as to whether or not tariffs are going to be implemented. They have to make decisions today that are 5 and 10 years in the making. And so even the discussion of tariffs is actively eroding people's faith in markets and the confidence that these CEOs have in how to invest, how to develop their companies, and how to build for the future. And so all of it is bad, and we're gonna put that there. But let's talk about a couple of different ways that it's bad. The chaos and the uncertainty. The mere announcement of tariffs creates uncertainty in markets in the short term. Caused at one point a sell-off and then a rebound Monday of this week when tariffs were going to be on. We opened up that market down 2.5%, settled that day at closer to down 1. But that type of chaotic environment doesn't really do anybody any benefit. Nobody knows which businesses are going to get their resources into the United States, which products are going to have the full brunt of the tariffs, which ones get reprieves. It is very difficult for allocators in the whole of the market to know who's going to be the winner when it's essentially a tariff is a tax on everyone. What it's doing right now that's kind of in the unseen world is some of the delayed investments. Businesses thrive on the ability to predict long-term outcomes for their investments, and tariffs mean that you are not going to build a factory in the United States because you don't know if that tariff survives the next 3 years. You're not going to build a factory in Canada because you don't know if the tariffs are going to be on the Canadian side. Truthfully, none of this is helpful. So a lot of projects are getting delayed, and investments delayed are investments lost. Everybody understands that the return on investment is a time question. It is not necessarily a how much in every case. And so right now we are seeing those investments delayed, which means that they could be delayed 30, 60, 90 days or 30, 60, 90 months in a lot of the long-term manufacturing cases. This week's industrial sentiment was actually lower than expected. A lot of people thought that the very first print since the election should see an uptick. The last ISM data came out was just below 50. This one was just above 50, resonating that even though they've seen a huge change, at which a lot of people were expecting to be a more industrial friendly policy regime, they didn't get that. And so now we're seeing pretty much a muted reaction saying as long as tariffs are part of the discussion, that the disruption into their decades of planning is actually causing them dollars. Tariffs destroy job creation. So nobody is going to hire, just like nobody's going to build a factory on either side of the line if they don't understand what the long-term run of tariffs are. And because these tariffs aren't expected to be part of a revenue collection by most people in Congress, by most people who are saying that Trump is just trying to get him to the table, we don't expect anybody to do any hiring changes as a result of them either. So it's not good for investment. It's not good for jobs. And finally, it adds to the cyclical damage that we do. As long as parts, particularly in the north, central Great Lakes region of the United States, parts for cars, parts for other manufacturing cross some of the borders multiple times, as well as the Mexican border, those things could be tariffed and tariffed and tariffed and tariffed, and then you're tariffing tariffs. This whole thing is a tariff spiral that really doesn't help anybody. We are of the mind that no tariffs should be placed on any U.S. goods or on any imports. We think that we import, the things that we enjoy and love, and that those tariffs are not costing us jobs, but in fact we're importing cheap labor by having these things constructed abroad. We don't really see an upside to a lot of this except for some bantering, and I think that the compounding effect of all this chaos is going to start having markets realize that there's less of an upside in this new regime. And if this is the behavior that we're going to continue to go through, I don't see a lot of movement on either side, and so I think that companies are going to stay paused, and I think they're going to delay plans, they're going to delay hiring, and everybody is going to wait and see how the dust settles, regardless of whether or not a single dollar is ever collected from any of these tariffs. Possibly the more impactful tariffs are the smaller percentage ones. Those are the ones trying to bring China to the table. We saw a resolution with the Canadian tariffs, again, in about 48 hours, and the Mexican tariffs in about 24 hours. The Chinese tariffs, only a 10% uptick, shows that I think that that's going to be a more complex situation. Everything that we were trying to renegotiate from 8 years ago is being relitigated today. We definitely think there are things that the United States government can get out of that situation, but we think that the tariffs is a bad route to get there. More in line with just level setting what international trade policy between these two nations looks like is the goal. So we're hoping that, again, those tariffs which are on products today get lifted, get some resolution, and get it quickly. For every day that tariffs go by, prices are permanently raised, and the inflation as a result of that is permanently part of the new ecosystem. So we're against these tariffs. We hope everybody is rooting for a quick and a quick and calm resolution to these situations. Well, this has been Nearsight and Farsight. I hope you learned something from us. As always, if you have any questions, please reach out to Peter, Carly, or myself. We'd be happy to answer some of your questions about what we're seeing and how we're reacting in the portfolio. Thank you very much.